Now imagine this. You are in your peak earnings years in your mid-40s or mid-50s, and you're in the highest tax bracket. You have the loss of a parent or parents, and now you're required to take all this money out, and half of it's going to, give or take, is going to be taxed away. So that's a real problem. It's a way that mitigates people's inheritance, right? And it also increases their tax burden. So how do you solve this? How do you deal with it? Well, if you are charitably inclined, there's a number of solutions that you can get into. There's one that we've done many times that I think is really interesting. It's really creative. And so what you can consider doing is you can pull the money out of your IRA and incur the tax. So let's just say you had $10 million in the IRA, right? And you pull it all out, you're getting huge taxable income that year, right? If you're in the highest tax bracket, federal and state, it's going to be somewhere between 40+%. So that's $4+ million on a $10 million retirement account. That's huge. What you can consider doing is simultaneously establishing a charitable trust. And a charitable trust, there's two types. There's one that's called the Charitable Lead Trust, where you put a tranche of capital in, that could be stocks or cash. You get a big deduction on that, and then every year you're required to send out a distribution to a charity. Right now, those distributions you don't get a tax deduction on because you got a big tax deduction when you put the money in. So let's go back to the scenario. You have the 10 million, you pull out the 10 million, you're going to have a big tax on that. But you still, before you pay the tax, you have the 10 million. So let's say you took, I'm just high level, back of the envelope, you took 7 million and you put it into this charitable trust. This is like putting all of your future charitable donations at one time, $7 million at one time, right? And you get a sizable tax deduction based on the term of how long you're going to give those distributions out. So now that $7 million that goes into that trust, the tax deduction that you're getting on that is going to offset the distribution from the IRA. You with me? Okay, now here's where it gets really interesting and creative. Every year for, let's say, the term of the trust, and this is all malleable. So let's say you had a 10-year term, meaning you had to take a distribution from that trust every year for 10 years and give it to a charity. So let's say hypothetically that was 4% of the portfolio. So every year you have to give 4% of the portfolio to a charity. Now you establish what's known as a donor advised fund, which is actually pretty cost effective and pretty easy to set up. And remember we exited the IRA for 10 million, but we only put 7 million into the charitable trust. Well, there's still 3 million out there. I'm not saving that for tax. We're putting that into the donor advised fund. Now, this is what's cool. We get another charitable deduction on our tax return. So depending upon your pre-planning, you can vastly mitigate the tax drag, in some cases wipe it out by utilizing this strategy. Now, here's the magic on it. The investments in the charitable trust and in the donor advised fund can grow on a tax efficient basis just like they would in a retirement account, meaning that you can make an even greater impact to the causes that you're passionate about. And this is where it gets even better. The charitable trust that you have to give a distribution to. So yes, you can give it to a variety of charities, but guess what else you can give it to? Your donor advised fund. So now your donor advised fund gets bigger and bigger and bigger. And what's cool is if you wanted to get your family involved and your kids involved, every year you can get the family together at a family meeting and say, look, our donor advised fund has X million of dollars in it. We want to make some donations. Let's all vote as to what charities we like and why. And it's a way that you could bring the next generation and teach them how to be philanthropic and at the same time mitigate the tax drag. And a lot of times people say, well, they were going to get their retirement account and now it's in this vehicle. It doesn't have to be an all or nothing. It could be partial, but at the end of the day, they're going to get taxed on it and probably spend it down anyway. So a lot of times that's what happens, not all the time. This is a way that you can mitigate the taxes, right? You can really get the family together. And also what's interesting is once it's in these vehicles, it's also outside of your taxable estate. And if you are in a taxable estate situation on a federal level or a state level, and those are two major differences, now we've just been able to remove $10 million from your taxable estate, which saves your heirs lots of money, millions of dollars potentially on federal and state. And on top of that, you got your family involved in being more philanthropic. And most likely, you've done a lot of good in the world because you've got a lot of assets that are going to charitable causes instead of the IRS.